Hello and welcome to this new training course. My name is Jorben and I'm a financial market analyst at Axiory. The goal in this training course is going to be to get you all the way from a beginner or a false beginner up until a point where you're at an intermediate level knowledge-wise and you can profitably start training yourself and not have to be dependent on listening to other people or listening to finfluencers who often don't really know what they're doing themselves, if we're being honest. The goal of this course is relatively ambitious, and because of that, I do recommend that you pay attention to just this, that you're not trying to do many other things. I know that's getting more and more difficult these days, but I still do highly recommend it. It's going to be so much easier and so much quicker for you to grasp all of this information properly if you just pay attention from the first time. Also, to help your comprehension, I'm going to be putting some summary of this PowerPoint, of this presentation online. It will just be a short PDF. So after watching this in 3 days, 5 days, a week, I don't know, whenever you have time, really, it doesn't really matter. You can just come back. Probably you're best of bookmarking the PDF, and then you can just read through it, remember everything, try to grasp everything, and it should help as a quick reminder and have things stay more fresh in your brain. And then once you've done that or before, it's really up to you. There will also be a link to Google Forms, and there will be a short quiz, and it's not going to be anything like in university or high school. You don't have to prepare for this, you don't have to worry about failing it. It's just going to be a quick test, also with the same goal as the summary, really just with the goal of trying to get you to remember things and correctly evaluate whether you were able to understand all of the topics. And it will just help you so much more down the line if you take the small amount of time it takes to just think about the questions and fill them in. They won't be that difficult. They're not going to be having any math, so don't worry about it all that much. Okay. Every single episode of this training course in the beginning is just going to have a short table of contents. So you can immediately just see what we're going to be looking at in that course. And there will also be timestamps. So for example, if you already kind of know all financial markets, you can just skip through it. I will make sure to provide it so that you can just easily skip to whatever you need most help on. Then before I get into things, I do need to just add a quick disclaimer. This course is for educational purposes. I'm not responsible for any risks, and you should seek a financial advisor who has the correct qualifications to help you with any questions you might be having. Okay, let's get into it. When we distill the goal of trading down to its very, very basics, really we're just trying to sell higher than we bought. And we can do this in one of two ways. Either I open what is called a long position, which means that I buy an asset now and I am hoping to sell it in the future for a higher price. Or alternatively, I can open what we call a short position, where I immediately now sell the asset and then buy it back again in the future. With a short position, what is happening behind the scenes, but you don't see any of it, is I'm immediately borrowing an asset. So let's say I'm immediately borrowing 100 Apple shares from someone and I am selling them immediately today at $100 in the conviction that in, I don't know, maybe 2 weeks, I will be able to buy them back at $95. And then I can just, once I've done that, I can give the 100 Apple shares back to its rightful owner. We don't know who they are. You don't need to know. It's all behind the scenes. And then that $5 gap times 100, so $500 will be my profit. And in that sense, we can profit from price going down as much as we can from price going up. So if we try and show that just quickly so you can visually understand it, especially for any people who learn just by visuals, let me get out my drawing tool, it would look something like this. I buy here and I sell here. The difference between the two is my profit. Alternatively, for a short position, it would something like this. I sell here, price does this, and I buy back here. The difference between this and this is my profit. And that's really all there is to it. Okay. Next slide, trading styles. We can subdivide how you're going to trade into two different ways. First one being your general approach, the tools you're going to be using. The first one is fundamental analysis, and the name already kind of gives it away. It's hard to find a better word for it than fundamental analysis. I think it's kind of bang on. And this is when you're going to be looking at the truly basics of an asset. What is the news? What is the data that drives it? For example, in gold, prices are driven by the risk-on/risk-off environment. Are people willing to be taking risks, or do they want the safe assets? It will be dependent on inflation. It will be dependent on interest rates. It will be dependent on the strength of other safe haven assets, like the US dollar or the Swiss franc. And we're going to be analyzing all of that information and come up with some unified meaning on, or unified interpretation of where we think price is most likely to go. For example, with our gold example, I might come to the conclusion that I think right now gold is undervalued. And then I will buy gold and I will just try and hold it until a point where I think the market is valuing it correctly. And my goal is that that selling price will be higher than my buying price. Next up, and what we're going to be focusing on the most in this training course, it's also by far the most popular technique, at least on a trading perspective, is technical analysis. This is when you're just looking at a chart. There's no ratios, there's no data. You don't even really need to know about interest rates or inflation. And you're just going to be looking at the chart. And based on certain chart patterns or whatever techniques you may have, you are just going to try and come to the conclusion that at this point, I think price is more likely to go up than it is to go down, or the other way around. And that's really all there is to it. In arbitrage, what is happening in its definition, arbitrage is when the same asset is trading at a different price on multiple locations. But let's try to put that into practice. This is common, for example, in Bitcoin. In Bitcoin, there is not really one exchange where you can buy or sell Bitcoin. There's many. There's tens, maybe 50, maybe 100. I don't really know, but there's a lot of them. And often they have different prices. And what might happen is that one Bitcoin on one exchange costs, I don't know, 85,000. And on another one, it costs 86,000. At that point, what I could do is I just buy one Bitcoin, or as much Bitcoin as I possibly can, on the $85,000 exchange, and I transfer it to the $86,000 exchange, and I sell it there for 1,000 profit per Bitcoin that I transact. And to a certain degree, as much as it is possible, this is a risk-free profit because it's still one Bitcoin. So why not just do it? And it sounds great, and it is great if it were as simple as that. But in reality, it's a lot more complicated than that. It's also something put away for more quantitative-oriented traders rather than what we're going to be focusing on. As I already said, we're going to be focusing mostly on technical analysis. Arbitrage is very much important to know, because you will certainly hear it, or you've already heard about it. But we're not going to be seeing any techniques about how to do arbitrage. Next one is sentiment analysis. This basically works on the philosophy that when too many people think that price is going to go in a certain direction, probably the opposite thing is going to be happening. For example, if everyone's convinced the S&P 500 will go up, it's probably the top. And then what happens in sentimental analysis is you will get people either just looking themselves at social media or looking at certain indicators and quantifying it and just trying to predict when positioning is too one-sided and bet on the opposite thing happening, sort of. Event/news trading, as the name already kind of gives away, this is mostly when you're focused on certain news events. These can be structural ones like inflation or central bank meetings, but also just unpredicted ones like a president just suddenly saying something that no one expected, a country starting war, anything like this. And often what happens is either you will try and predict what's going to be happening before it happens and then positioning, or as the news event is happening, you're seeing how the market is reacting to it, is interpreting it, and then just getting in before the whole move has died down. Macro is kind of similar. It's when you're looking at just interest rates and how the economy is doing and unemployment. And often what you're trying to do is predict what central banks will do, whether they will cut or they will hike rates, and that has a big effect on markets. And with macro, you're just using all of this macroeconomic data, as the name says, to predict what prices in certain assets will do. Now, on top of our styles, we can also categorize trading based on how long someone holds a position. And this is actually strongly correlated to the style itself. For example, if I start with the lowest, with the shortest time frame, this is something we call scalping. In scalping, what's happening is you're opening and closing your position in a matter of seconds or minutes. You're really just taking teeny tiny bites of price and doing it many, many times over until it points where it gets to a decent amount of profit. And scalping you will only really see happening with someone who uses technical analysis. Because for other techniques, you're just not leaving enough time for the rest of the market to discover, especially when we're talking about fundamental analysis. If I think gold is undervalued, I need to leave enough time for the market to also come to the opinion that gold is undervalued. If I'm going to be holding a position for seconds, then obviously that's just not going to happen. So scalping really only happens with technical analysis. Day trading is when you're holding your position for, I would say, at least like 10 minutes all the way up until the whole day. But a day trader will always try to close their position by end of day. They don't like having exposure overnight, and either when they go sleep or when the markets close, they will also close their position. Here also the dominant approach is still very much technical analysis. It's very difficult to do this on a fundamental analysis perspective. It might be possible for sentiment analysis or event/news trading. It could happen there, certainly for arbitrage as well. But we're still like on the crossover between the shorter and the longer time frames. Then another step up is swing trading. This is when we're going to be holding our positions for a couple of days, a couple of weeks. This is where really any technique becomes possible. This is often where people will combine both fundamental and technical analysis. And then the highest one is position trading. And in this style, you may be holding positions for months or even a year, 2 years, something like that. This is the category that's closest to investing, if you could say it that way. And at this point, you're very likely to be looking at fundamental analysis because over the long time, this is going to be the main driver of price. You cannot see like any news coming up in charts. For example, if you look back at the COVID pandemic, even if you were very good at analyzing charts, if you were looking at it in early of 2020, you cannot possibly have predicted such huge of a drop because it was just purely due to the COVID pandemic. And that's kind of what happens when you take trades that take longer to play out, is that you need to be watching news, you need to be watching the very basics of what drive prices rather than just looking at what's happening on the chart. Okay, now that we've got that out of the way, let's go to the essence of trading. Trading, it's a unique discipline. I think we can definitely say that. It's hard to make an accurate comparison. There's some comparisons that can be made, but really it's kind of trading is a thing in of itself. Our first part, I'm actually only going to mention very shortly. Probabilistic thinking and edge, because we're going to be seeing it very quickly in our next slide even. But basically it just means that we are never certain what's going to be happening. Even if I'm a very good trader, I don't know for sure that in the next trade, price is going to be wherever I expect it to go. Trading is not a hard science. I cannot just come up with a formula and then just be like, price is going there. If I would, I certainly wouldn't give it to you. I think that would be not so smart on my end, but there is no such thing. But exactly because we can never be sure, we need risk management and account management. If I'm at best can only be 80% sure about what's going to happen, I cannot bet everything because eventually the 20% will roll around and I will just go bankrupt. Because of that, we need to be smart with how much we want to risk. We want to risk enough so that when we're right and we did our analysis correctly, we're going to be making enough profit from it to get rewarded for our efforts. But we also don't want to get bankrupt. I think that speaks for itself. Third is decoupling process from outcome. This is also linked to probabilistic thinking. If I am right 80% of the time, there will eventually come a point where I'm wrong 3, 4, maybe even 5 times in a row. And in those situations, things become difficult. I need to recognize that I'm still doing that I'm still doing the correcting over the long term. And I'm looking at my long-term process and not the outcome of 1 or 2 or just a couple of trades. This is also directly linked to emotional control. When I'm inevitably hitting multiple losses in a row, which is almost impossible to not come across, I will need the mental strength to deal with it. And maybe the mental strength is a bad word to describe it, but I need a good system to be able to deal with those emotions. Also, we have something, information asymmetry. It's closely linked to the concept of edge. It's basically just being more certain that price will go in one direction or the next. I'm going to be going deeper into edge very soon. But first, I want to go to the next slide where I will show you this. My dear AI assistant helped me create this. And it ties back to our concept of probabilistic thinking. On both sides of the scale, we have 100% skill games and 100% luck games. Luck games are pretty simple. It's just betting, lottery. You could not possibly predict what's going to happen. You're just hoping. And then on the other hand, we have 100% skill games. For example, football, chess, but quite a bit of sports fall in this. To be completely accurate, you have to put it at like 99.9% because there's always some luck involved, but they're mostly skill-based games. And what I mean with this is that if you put me against the best player, the best football player, the best chess player in the world, I'm going to lose every single time. Even if we play 50 games, 100 games, maybe even 1,000. The only way I'm going to be winning is either if the guy is sleeping for chess or if the footballer just, I don't know, broke his legs or something along those lines. Otherwise, it's just not going to happen. Trading, on the other hand, is somewhere in the middle. I cannot give you the exact percentage, but 50-50 is not that bad of an assessment. In trading, there's certainly some luck involved, although we don't call it luck in trading. We talk about variance, which is more closely related to statistics, which is something I'm going to be talking about later as well, but don't get scared when hearing statistics. It's not that scary. But I have an analogy to try and explain it. If we put me up against 100 monkeys, and these 100 monkeys all have access to a trading account, and they can just click buy and sell like with a market order, and we let us trade for, let's say, 5 trades, then there's going to be actually quite a bit of monkeys that will do better than me. Over 5 trades, I really can't say for sure whether how good I will perform. I mean, it's very likely that because I'm going up against 100 monkeys, that multiple monkeys will be doing better than me. And even when we're doing 10 trades, there will be less, but there will still be monkeys ahead of me. Even when we're doing 20 trades, there might still be a monkey ahead of me. And obviously, it does not mean the monkey is a trading genius and he knows where the market is going to go because it just feels it, but it's just the concept of variance. It's that in trading, we need enough time and we need enough trades for skill to come out. We don't know whether you're skilled or whether you're lucky when you've just taken a couple of trades. We need more trades to find that out for sure. And that completely gets us to my next topic, the law of large numbers. This is my statistics, and if you've ever had an intro to statistics course or even just in high school, I don't know, you might have heard about this. And basically it just states that odds or chances can only accurately present themselves when there's enough instances to be repeated. In statistics, we call this that the sample size needs to be big enough. And my earlier explanation might have raised some worries from some of you. The question might go somewhere along the line of, if after 20 trades a monkey beats you, then what are you really doing? Are you wasting your time? Like, is trading just gambling? And the answer is no, not really. Exactly because there is luck involved in the short term. And because we need the law of large numbers to understand that short-term results are kind of random. My next trade, when I finish recording and I take my next trade, technically it's a toss-up. Anything might happen. I really don't know what's going to be happening on my next trade. But on the long term, if I do this certain approach over 50 trades or 100 trades, I will find that actually I can predict where price will go over the long term, but I will still have plenty of trades where I don't. I might, for example, be right 70% of the time, but there will still be 30% where I'm just wrong. And hence we can to a certain degree say that short-term results are just random. And this following graph is going to explain the law of large numbers further, to explain why we need enough trades, why our sample size needs to be big enough to accurately assess whether we have skill or whether we have luck. Skill in trading we often just call edge. It means more, but we're going to simplify it for that. And what we're seeing on this graph is, on our x-axis, the number of coin flips. And I think pretty intuitively, everyone will agree that in a coin flip, there's really 50-50 odds where it will land. Either will be head or tail. Unless I'm screwing around with my coin, the odds will be 50-50. And these graphs, along with the y-axis, is showing the observed average. So let's say, for example, I do 10 coin flips and I will count whether it gets on heads or tails, and then I will calculate the odds of it being heads. And that will be my observed average, is how we will call it. When we look at the very beginning of the charts, for example here, this kind of yellowish line, where there's about, let's say, only 20, maybe 15 trades, we see that it's a long way away from the middle. Here is our 50% average, which we know by definition has to be true. The odds of heads or tails are 50-50. And yet when I'm doing 15 flips, excuse me, my average might be 0% or 100%. It's really not out of the ordinary, especially if you do a lot of coin flips. There will just be an occasion where you have 10 instances in a row where it gets heads or tails. And it's only once we gradually do more and more and more coin flips that we can see the price, that these lines go kind of closer and closer and closer to our 50%. And eventually, if you do an inhuman amount of coin tosses, you will see that all of the observed averages will converge with the true average of 50-50 that we know is true. And that kind of is all there is to the law of large numbers. I really hope that was clear. It was probably the most complicated part, the most difficult part about the trading course. So from here on, it's kind of downhill, although not too much. So don't fall asleep. Okay. The next part, financial markets. Now that we know kind of how trading works to some degree, what can I trade in the first place? There's 5 major categories, and we're just going to be seeing these 5. There's more, but at that point we're getting kind of obscure, and that's not the goal of this course. First one is stocks, pretty simple. Can go over this quite quickly. Microsoft, Apple, just trading these shares and expecting price to go up or down. Indices, these are collections of stocks, often grouped together based on geography. For example, the S&P 500 are the 500 biggest American companies, the Euro Stoxx 50, the 50, biggest stocks in the Eurozone, and basically every country has their own stock index. The next one is commodities. This is the broadest category. Here we have 3 important subdivisions, which you will often see a reference, or you might have already heard. The first one being metals, so gold, silver, copper, but also platinum, zinc, nickel. The second one being energies. This is quite a small group, but nonetheless actually one with a large market cap. This is oil, so both WTI, so the American equivalent, and Brent, so the European equivalent, and also natural gas. Those 3 are by far the most important ones. And then finally, we have something called soft commodities, also often referred to as just softs. By definition, soft commodities are regenerative, meaning that they are crops or animals that we can just keep creating to some degree. This is corn, but also wheat, sugar, coffee, cocoa, even live cattle is a financial market. People don't often realize that this is actually a financial market. But it's very much this. There's a lot of edge to be found in these markets. They're not as popular as some of the other ones, but that doesn't make them less relevant. In fact, there's a good case to be made for specializing in these markets. And then fourth, we have, in terms of volume, in terms of daily transactions, by far the biggest one, Forex. And this is when you're trading euro dollar or pound yen or the Swiss franc against the New Zealand dollar. There's really endless combinations, and I think this is hopefully the most intuitive one. But it's kind of like when you go on vacation and you need to exchange your money for the money of the country you're visiting, and you're selling your own currency for the other currency. And we're kind of just doing the exact same thing as there, but it's just on a much larger scale, to be honest, in a digital environment and with better prices. But otherwise, it's a very good comparison. Last one is our newest and our youngest category, cryptocurrencies and digital assets like Bitcoin and Ethereum, most notably. I'm not going to be talking too much about them. I think they kind of speak for itself, but they are also very unique markets. They have a lot of nuances to them that other markets don't have, and they require an adapted way of trading them. Okay, my final slide already before I get to the conclusion. I just want to quickly clarify what a broker does, because sometimes I find that there's some confusion about what their function actually is, especially amongst beginners. And really, a broker, its very, very core function is pretty simple. I, as a trader, and you as a trader, we are way too small to be putting our orders directly into the markets. I cannot just call the New York Stock Exchange and be like, hey guys, I want to buy 2 Apple stocks. They don't care. They don't have time for 2 stocks, for 2 shares. It doesn't really interest them. So what happens instead is I need an intermediary. I need a broker who is going to route my order into the market and make sure it's executed at the price and the quantity I desire. But on top of that, they also have 3 other core functions. First one, they provide charting software. So often MT4, MT5, CTrader, TradingView, whatever they offer, it doesn't really matter. But they will give you a platform of some form that is just free to download. That's just part of being a client there, where you can analyze charts, where you're finding all your data on what the prices is of every asset, and where you're just putting in your orders. Also, they're offering something called leverage. Leverage is a very controversial topic, sadly. And by its very basics, what leverage is kind of like borrowing money. And that sounds scary, but let me continue. If I were to trade as a day trader, for example, on the euro-dollar pair, price doesn't really move that much intraday. Like over 1 4-hour time period, price might move 0.2%. And that assumes I get like the very bottom of the move to the very top of the move. And that never really happens, sadly. And at that point, trading is kind of not worth the time effort, is it? I mean, as it takes 4 hours for price just to do 0.2%, and that's assuming I'm right all the time. That's assuming I get the absolute top and bottom. For 0.2%, I'm already going to do all this effort. So what we have instead is leverage, which really just means we're borrowing money just for the amount, for the length of the trade, and we don't see anything. It's also just completely behind the screens. But for example, I might be asking the broker to give me 5 times as big of a position as what's on my brokerage account. For example, I might have $1,000 and I will use 5x leverage, which means that my true position size is now $5,000. My 0.2% move then turns into a 1% move, and at that point I can be like, okay, this is a move I want to put effort for. At this point, trading is actually worth it to make a decent amount of profit, especially because you can go much, much higher than 5%. Some of the brokers offer leverage in the hundreds, and while you certainly won't be needing that much, it is useful to know. And so in and of itself, while leverage is scary because it also magnifies losses as well as profits, it's really an essential tool for trading to be worth our time in the first place. Also, we have liquidity. If I were to just wait only for other traders to be able to execute my orders, it might take a long time. Especially if you're trading larger positions. For example, if I wanted to sell 1,000 Apple shares, I would have to wait for enough people, either one or multiple people, that want to buy 1,000 Apple shares. And that's not even considering the fact that it might be at a very specific price that I'm asking for, that I only want to sell at $70 per share, for example, and the current price is $65. And in that situation, it might take a very long time for my orders to get executed. So instead, what brokers make sure happens is either they do this themselves or they get an outside firm to do this, often called market makers, is they will take the other side of your position. So your orders are quickly execute it whenever price is at the point where you want it to be executed, and you can get easily in and out of positions without too much hassle. And I really already kind of rounds up our first episode. Just a short recap of the most important parts. As we talked about with the law of large numbers and our pretty little image about skill and luck-based games, we need enough time and enough trades for true skill or edge, if you want to put it in trading terms, to appear. On the short term, one trade is kind of a toss-up. Trading requires, because of probabilistic thinking and because of this element of odds of chance, it requires emotional discipline. It requires learning risk management, to not bet everything and also not to bet too little, and to prioritize what's correct in the long term over a short-term result. And finally, the markets we choose dictate the fundamentals we need to master, how we will try and get into positions, and the style we choose is very much linked to what things we think we are good at. And so the decision of what market to trade and on what time frame and with which approach is a pretty important one. And we should be picking something that aligns with our interests, but also aligns with how we are as a person. Am I good at dealing with stress, or am I maybe a bit more scared? Do I like spending a lot of time thinking deeply about one subject, or am I good at being quick and multitasking? Things like that. And that actually sums everything up, that concludes it. So as I already said at the beginning, do make sure to just look at the summary notes in a couple of days whenever you have time. Fill out the quiz either now or afterwards. It's really up to you. These are small steps. They will take you maybe, I don't know, 5 at most 10 minutes, and that's already quite a bit to do, and it will help your understanding a lot. It will make it much, much easier to follow everything in the coming episodes, because there will be a lot more. We have so much more to see. But that's really everything. I really want to thank you for taking the time and watching all of this. I know sometimes it's not that easy to carve time out to just watch this, and I certainly highly appreciate it. And I also very much hope to see you again at the next episode. And that's everything really. So thank you and take care.